Hey everyone, welcome to today's show on Wealth Strategy Secrets. Got another great show for everyone today. Today we're joined by Jeremy Roll. Jeremy has forged an incredible career path since 2002. After leaving the corporate world in 2007, he dedicated himself full-time to passive cash flow investments and successfully built up a portfolio worth over 1 billion with more than 60 opportunities across real estate and business assets. As founder and president of Roll Investment Group, Jeremy helms a group of 1,500 plus investors aiming for profitable returns through managed investment solutions. He's also co-founder of FIBI, For Investors by Investors, a nonprofit organization launched in 2007, which seeks to bring education and networking together within California's largest public real estate investor meetings without any sales pitches being made. With an impressive MBA from the Wharton School and a global network, Jeremy is ready to help real estate investors of any size. He currently serves as advisor for Realty Mogul, the largest US-based crowdfunding website in the industry, with over 30,000 members on board. Jeremy, welcome to the show.
Thanks for having me. And I just want to clarify one thing in the intro. I do not have a personal portfolio of $1 billion myself as an individual. I am invested amongst more than $1 billion of assets, like actually much more than that. But I have a small piece of that. So I just want to make sure
Equity partner. Yeah.
Yes, exactly.
Absolutely.
So I just want to be sure people didn't get the wrong impression. But thank you for
Yeah.
having me on. Really appreciate it.
Yeah, you bet. Really have been really looking forward to this discussion, Jeremy. You know, where your investment thesis is very strong and compelling, and I think is going to add a lot of value to investors. So why don't we start with, for those folks who aren't really familiar with you, can you tell us a bit about your background and your journey, and then how you got into the space?
Sure, yeah, and thanks again for having me on. Hopefully this is helpful for whoever's listening, and thanks for joining us. So I am originally from Montreal, Canada, grew up there, and basically did an undergrad in business at university there. I had a few years of work experience and then came over to the US, and my transition was basically getting an MBA over at the Wharton School at University of Pennsylvania. And I graduated in 2000 with that and then moved to LA, where I've been ever since. And from an investing perspective, what happened is that after the dot-com crash in 2001, I was just sick and tired of being in the stock market from the perspective of both volatility and lack of predictability. And with the lack of predictability being even the more challenging thing for me, just for my long-term retirement strategy, it was just incompatible with me being a pretty slow and steady guy. And so I started to look at different ways to invest. Came across the concept of cash flow and more predictable cash flow for stabilized cash flow. And so I started rotating into those types of opportunities in 2002 with real estate. Ended up rotating all my money from stocks and bonds into cash flow type opportunities between '02 and '07. And interestingly, I did not have a plan to get out of the corporate world with this. I actually meant just to have the paycheck and more predictable type of investment strategy for the retirement side. But I had a last straw moment with my manager at the time. I was working at Toyota headquarters in Los Angeles and decided to take a chance and leave the corporate world because I had the cash flow built up to live off of, even though that wasn't my intention. So I've been investing in these types of opportunities since 2002, so over 20 years, full time since 2007, so over 15 years. And I'm highly diversified, so I'm in over 60 different opportunities. Currently, I've been in over 150 to 200, since 2002. I'm just a huge fan of diversification, and I've always been passive in how I invest. So I'm not always necessarily in real estate. I'm in other things as well, but everything I do is passive where someone else is managing it. That's really one of the key things for me. That started because I was just too busy when I started investing in 2002 to do it actively. I was actually working at Disney headquarters then, and it was just too busy to do anything actively. And then even when I left the corporate world, I just found that it was a better personality fit for me to be making bets on people rather than doing things myself. So that's my background.
Great. And was there a spark for you, Jeremy, that really, drove you and compelled you to get into passive income theory?
Yeah, it was definitely really it was more of a motivation to get out of the stock market. For those of you who weren't around or in the stock market back during the dot-com crash, it was highly volatile, huge crash, and not knowing. So the concept of not knowing where my retirement account would be in 10, 20, 30 years because I didn't want to see something go up and down 30% in a year. It just wasn't compatible with what I was trying to find. It was really that motivation that sparked me to try to find a different way. So it was trying to find a different way out of stocks for the long term was really what motivated all this.
Right. And then did you develop a particular investment thesis that you have today that you've really refined?
Yeah, I would say that interestingly, I've had the same general focus since 2002, and I've tried not to vary off of it because it seems like a really good personality fit for me. Which is, I've always looked for stabilized cash flowing opportunities, preferably asset based, but not always. That, let's say, from a real estate perspective, are 80 to 100% occupied, stabilized, may or may not have any value add upside. That's optional to me. And I tend to invest in value add at certain parts of the cycle and try to avoid it other parts of the cycle from a risk perspective. So I do change what I'm doing depending where we are in the cycle. But the general philosophy is highly occupied, stabilized, cash flowing opportunities for more predictability. So I'm not about getting huge gains. 1% of the investing I have in like a whole bunch of startups, but I'm not even looking for those. It's kind of have to make a bet on someone I know type of situation. 99% of my focus is more predictable, stabilized cash flow. And it really has to do with personality fit. I mean, that was my goal from the start. And for example, 20 years later, I still haven't invested in a development opportunity ever. And it's just because I've been tempted to, and I've missed some interesting ones, but it's just a comfort level more than anything, just a personality fit more than anything.
Yeah, I think that's such a great point, and people really overlook that. And it's really the investor DNA that you have, and some people, if you like that trading, environment or volatility of the market, I mean, maybe some people thrive on it and it's for them. And, there is money to be made, but it's a completely different game than, being in real assets, right, that are predictable.
Yeah, I agree. But I tell everybody the same thing. Look, there's 1,000 ways to invest. None of them are wrong. It's whatever is the best fit for the person. So, if someone is a 100% startup investor, I've met those people before. That's probably the best fit for them. That's the best personality fit for them. And the funny thing is, like, I'm fully convinced that a lot of people will do much better than me in the long term if they're taking more risk, right? Just not the right personality fit for me. And it's not what allows me to sleep well at night, basically.
Yeah. And so let's just rewind a little bit. So, I mean, a lot of people still do have positions in the equities markets, right? So,
hmm
for you shifting into your portfolio today into real assets and everything, after going through your, due diligence and research and analytics and everything, what is it that's really, so much more compelling to you about investing in these types of assets versus the equity markets?
Yeah, I would say that first of all, and it's interesting because over time it's changed. But when I started, it was pretty clear to me that if I made good choices, given where pricing was, that I could probably outperform the stock market by a pretty wide margin. I don't mean that to say that I'm some amazing investor. What I mean is that the opportunities I was looking at with the projected returns were significantly higher than the long run average of the stock market. So much so that if you compound the difference, it just makes a huge difference because I started pretty young. I was 28, many decades down the line. So that was really interesting to me long term in terms of building the wealth slowly but surely. And the fact that obviously they presented more predictability to me was also a much better fit. So knowing that, let's say, most of the opportunities I have invested in involve quarterly cash flow distributions that are projected, and getting that cash flow, whether it's reinvested or you live off or whatever it's for, just having that cash flow coming in, knowing that's more predictable than, if you buy Apple stock today, is it going to be 10% higher next year at this time, or is it going to be 8% lower, 20% higher? I don't know. But that lack of predictability is really tough for me. And so the cash flow is a huge focus of mine, both because I live off of it, but also helps to generate some of that predictability. And I focus much less on any appreciation. To me, any appreciation or value add upside is just gravy. And it tends to happen with inflation, tends to happen with mortgage pay down over time if you go into a long enough term. But to me, it's just gravy. My primary focus is the cash flow piece. And that's really important to me.
Yeah. Do you have a particular a calculator or some type of analytics that you run to manage your portfolio?
No, it's actually really rudimentary. So I focus on cash flow, right? So what I do is a lot of the opportunities I invest in tend to be 10-year term, okay, based on a 10-year fixed rate loan. And so they'll have typically annual cash flow projections. And so what I'll do, including some type of payout at the end that is projected upon some sale. And so what I do is I have a spreadsheet that goes out over 10 years that is, the rows are each opportunity. It's by month. And I will take, let's say if year one's projected cash flow is 9% projected net to investors, okay? I'll take that divided by 4, and then I'll put it in the month that I believe they're going to actually make that distribution, because it's not exactly when the quarter ends. It could take 30 to 60 days for a distribution to be made. And I'll just put it out the entire way of the entire span. And this is just a rudimentary Excel spreadsheet. It's nothing fancy. And then what I'll do is every time I get a distribution every quarter, I'll compare the number I got compared to what it was supposed to be. And if it was plus or minus 20%, I just let it be like, it's okay, it's in the normal range, because projection is projection. It's never going to be perfectly accurate. It's certainly not when you consider all the factors of expenses and revenue and everything, right? And so if it's in the range, I let it go. If it's more than 20% out of the range, either way, I will make sure I understand what's going on. And if not, I'll start asking questions. So whether it's covered in a quarterly report or I have to ask more questions about it, I'll get to the bottom of why it's out of range. And it's interesting because to me, it's almost as important to understand why something's overperforming than underperforming. Underperforming is more important, clearly, for cash flow. But if something is way overperforming, why? Why did that happen? What has been done right? Did market conditions change? Would they do something strategically that was really good for investors? Are they getting lucky? Are they performing really well? And can I learn from this, right, for the future? So I look at outside of the range plus or minus 20% if it happens to flag. And that's how I track everything. So it's really rudimentary.
Makes sense. And then from a due diligence perspective, I know you have a very, conservative approach with how you look at particular investments. But, if you were to summarize what are, some of your top 5, ingredients that you're looking at to, to invest in something, what does it really boil down to for you?
Yeah. So, and to your point, like we could have an hour, 2-hour discussion about this alone. But so from a high level perspective, the first thing I'll say is very, very high level. I'm trying to find, so even a further step back, to me, who I'm making a bet on is more important than what I'm investing in. But it's a close second, the actual assets you're investing in. But to me, the people are the most important thing. So I'm trying to find someone who's conservative, who's using conservative projections, who is looking to underpromise and overdeliver for investors by lining up their assumptions like that, and is looking to build long-term relations with investors as a result of overperformance. I'm trying to avoid someone who is using big numbers, trying to market to people, trying to attract people with their numbers, possibly being aggressive with their assumptions, maybe even using a lot of fancy marketing to do so, who is set up to potentially underperform, and they don't necessarily care to build a long-term relationship with you because they just want to get investors in, and they're just a marketing machine, and they'll just get another investor, if it doesn't perform well for yours. So high level, that's what I'm trying to find, and it's trying to align with my more conservative personality, right? There's a few things to consider, to add some points to that. First of all, I always do a background check. That is an absolute rule. And if I'm reinvesting with somebody, I'll do a background check every time. Okay. Now, if it's 2 deals within a month, I'm not going to do it again. But if it's been a few months, I will run it again on every manager of the managing member, every member of the managing member entity. To me, that's very, very important. I don't really care who I'm investing with. That's an important thing. I've saved myself in the past for sure with those. So that's a rule that I think, unfortunately, a lot of investors don't necessarily follow or execute on, and I think it's very important. I also want to invest with someone who's experienced, because I know this doesn't really sound great, but I want to avoid someone learning off of my money. And unfortunately, when someone's new, that's part of what's going on as a learning process. So I tend to require someone to be pretty experienced. Doesn't have to be 20 years of experience, but can't be the first, second, third, fourth deal type situation. And I also I think this is really important. Over the years, I've refined what I target and created a much more and more narrow box that I target over time. And why that's so important is because it avoids you wasting time on stuff you shouldn't be looking at. So, we talked about developments, and I've been tempted by a couple developments on people that I really want to make a bet on before, but I just stayed in my box because that to me has always worked well. And I feel like it's just the guiding light that's going to work well because it's the right personality fit for me long term. And so, and by the way, that is extremely helpful when you're dealing with times where at the end of a cycle, when people are making a lot of money, like recently, in doing shorter term deals or in betting on crypto, whatever it is, right? I may make tiny bets on that because I get tempted, but that helps to guide me still to stay away from making bigger bets on stuff like that. So formulating what you're trying to target, even if you're brand new, the better you can formulate that down and synthesize it by asset class, I think the more successful you're going to be at both staying in the right course and not getting distracted, but also it's going to help you to avoid wasting time. So those are some quick things coming to mind. And I would also tell you, try not to like if you're brand new, I always recommend. I'm not a financial advisor or anything, so just my perspective as an investor. But I always say, look, focus on one asset class first, learn it, and you can then transfer 80% of that knowledge to every single other asset class. Let's say within real estate, as an example, because there's revenues, there's expenses, there's things to consider. There's entry prices, extra exit prices, multiples on those. There's interest rates, loan structures, and a lot of it is very similar. And so don't, if you're, especially if you're new, don't get distracted by 10 different things and you kind of get paralyzed, not sure which one to start with. I would go with the one that you understand the best from the start. So if somebody is a brand new investor and they lived in mobile home parks when they grew up, I would tell you focus on mobile home parks first, because it's going to be your lowest hanging fruit, the easiest one for you to understand first, right? A lot of people tend to start with apartments because they've lived in apartments, they understand them, it's a relatively straightforward business model, and then they'll learn from there and move on. But try not to get distracted by all the asset classes when you're early on. It can be very distracting.
Yeah, so many great points there, Jeremy. I think having a really solid buy box to what you're looking for is really key, as you said, because that way, I mean, we get many deals every week that come across our desk, right? But it's so much easier to say no, right, when you
Yes.
understand what you're looking for. And we spend a lot of time connecting with our investors and really running surveys as well to know what people are looking for. Are they looking for cash flow? Are they looking for value add plays? What are the dynamics, right, of a deal that they're looking for? And then you can just get so much more laser focused in terms of what you're doing.
Yeah, I couldn't agree more. Yeah.
Yeah. So no, I think that's really sage advice in terms of providing some of that due diligence up front for you as an investor, and really betting on the team. I would echo your sentiments on that as well. It's always betting on the jockey and not the horse, right?
Yes.
And another factor that I'll throw in, especially right now, given where we are in the markets, is not only having that consistent track record, right, from the operating team, but also do they have a healthy balance sheet, right? Because a lot of newer players or folks who've kind of gotten into this game maybe not necessarily should have. And if a deal starts to go short, like for instance, right now, if they didn't have a rate cap on their debt terms, starts to get more expensive, and then they have to fire sale the asset, you want to know that they're going to do right by the investor, whatever it takes.
Yeah, and I actually just want to point something out because it's funny. I have not invested in any floating rate deal. One that I could think of that had literally a 20% loan to value, and it was industrial building. It was a whole, odd situation. But generally speaking, in the last few years, I've not invested in one of those types of deals. And I thought that the term rate cap, just because I never looked into it, meant that you bought the rate cap up front, and then, on a 5-year term, say your rate is capped. But it doesn't work like that. And I mention this to everyone who doesn't understand those yet, in reference to understanding the balance sheet of people, or the sponsors, because the rate cap is usually purchased for only 2 or 3 years, and very commonly 2 years. And because rates shot up and are expected to be high, right now I've heard of stories of people paying $50,000 for the first 2 years of a rate cap, and now it's $4 million for the third year. Like, real story. I just spoke to somebody this week who's a sponsor who has that situation. I didn't know it worked like that, and that's a huge risk right now to people's balance sheets. So if you're looking to start with a sponsor now and you're trying to understand them, if they've done a lot of shorter term deals, I think you have to dig into like exactly how that's gone. Have they refied out of all of them? If not, what are the risks? So that came to mind. Sorry, I know it's random, but just to pass along to everybody, because
Yeah,
it's
no,
something I
great.
personally just came across, and I think it's going to come up a lot, unfortunately, in the next 2-3 years.
Yeah, I think you're right. So I think that's a good segue, Jeremy. Why don't we talk a little bit about the market and kind of, your perspective on, what you're seeing. There's so much going on right now, and everything is moving just so fast. Sometimes it can be hard for investors to kind of make sense of it all. So, give us your take on how you're viewing things right now.
Yeah. So, what I always try to do is take a look at what's happened in the past and try to apply it to what's coming up in the future. Just take history and see what may happen again. And so, what I am personally doing is mostly on the sidelines. So, when interest rates start to go up, prices start to adjust. That's currently in process. Real estate tends to move slowly in that there tends to be a while before a seller tends to capitulate to true market value when the market's shifting. And so, usually, if you look historically in these types of situations, it could take 18 to 24 months to reach a proper bottom pricing, and sometimes longer. And so I'm not in a specific rush because I'd rather be late than early in this particular scenario. Not that I wouldn't invest in a deal that was very unique today. I would. There's always unique opportunities, but as a general mantra. So right now I am sitting around and waiting to see what happens. And what's obviously happening is there's been a price adjustments and they may continue to go down. So let's just use multifamily as an example. I've been hearing most sponsors tell me they've seen 10 to 15% price adjustments. But what strikes me as an investor, and this is what I'm very focused on at the moment to keep myself grounded, is if I'm going to put my equity to work, historically, how much of a spread do I need between the interest rate and the cap rate, right? Because if you're saying, where are we in pricing? Is it going to go lower? I'm looking at that as one of the very important metrics I'm trying to follow to see if and when things may stabilize. Because I've seen still negative leverage negative leverage deals come up. And I don't believe that most investors are probably going to be comfortable with those. And again, I'm just one person's opinion, so I could be wrong. And even some of the non-negative leverage deals I've seen, maybe the cap rate's the same as the interest rate, or the cap rate is perhaps maybe 50 basis points higher than the interest rate. But historically, that has been 100, 150 basis point spread that an investor would earn for the risk. And so there should be a spread, and it hopefully will be 100, 150 basis points. So until I start to see that to begin with, which is not happening yet, I know it's not really time to jump in or consider anything unless it's very unique. So that's a very important metric I'm watching, but I'm also just trying to go with the flow, knowing that first of all, we may have an economic downturn next year, and a lot of people are expecting that. And I think what's been priced into the cap rates so far that have adjusted have been an adjustment based off of interest rate reaction, which isn't completed yet because it takes time. But I think the other shoe to fall that hasn't happened yet is if we do get a recession. In a recession, two things often happen, and usually happen. Vacancies go up and rents go down, right? And so if that happens, then we're going to have an NOI shift, right? A profitability shift. I don't think that's been priced in or into people's thoughts yet. It's starting to, but it hasn't been there. And I've been talking about it with people since March, but that was like when people couldn't picture rents ever going down, right? So now we're finally getting there. It takes a while. So those are some key things I'm looking at to guide myself at the moment. But to your point, it's very complicated because we don't know where interest rates are going, which will impact cap rates. We don't know if we're going to have an economic downturn or not. We don't know how bad it's going to be. And just to keep it simple, I'm just assuming we're going to have a medium recession because we don't know how big or not big the recession is going to be. It's a very odd time with jobs the way they are. I read an article the other day. There are 4 million people who are currently unemployed because of long COVID, right? That's a lot of people who are out of the workforce who would otherwise be in the workforce, who would potentially, some of those people be unemployed. The numbers will look worse. Just as one example. So there's a lot of complicated factors going in right now into this equation. But to keep it simple, I'm just trying to use the regular recessionary playbook, and that's why I focus on those key things to keep it really high level. I always find that when things are complicated, if you keep it high level, it makes it much more simple.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah, I would agree. It's like really focusing on the fundamentals of things, right? So do you see, let's talk about the broader economic picture, right? And what do you think about that in terms of next year? I mean, there's again, we have an energy crisis going on. The currency right now, I think fiat currency is just really potentially on its last leg, right? And the impacts of potentially that, right? So runaway inflation, right? And so if we go into a recessionary environment while there's inflation, that's a little scary, right? We haven't seen that in quite some time. So what are you thinking, as a sophisticated investor right now to positioning yourself during this time?
Yeah, what I would say is that first of all, I think that point about having inflation during a recession, which is basically stagflation, is which is really tough because if you think about that comment about NOIs going down, that makes it even worse, right? Because your profitability gets hit by inflation, and yet your rents may be coming down at the same time, which is really tough. And that's why that piece may become much more in focus next year and even more important than people are talking about right now. We'll have to see. So I do agree there's a lot of factors out there that could change things. The Russian oil situation, where I think, people won't be able to get the exports of Russian oil soon. That could impact oil prices and increase inflation. And some people are speculating it's going to happen next year. We'll have to see. By the way, that supply could come from the US and other places, so we don't know how that's all going to work out. So the way I'm positioned right now is pretty heavy in cash. What I'm doing is going into unique opportunities that still make sense, particularly ones where I don't have to worry about asset prices decreasing. That's my primary concern at the moment. And also been buying, in fact, just this morning, I bought some more, been buying a lot of short-term treasuries to bridge the gap. I'm not happy about it. It's not keeping me close to and on par with the true inflation, which, by the way, I think is much higher than what gets published for a lot of reasons, right? It's not the way they used to calculate it. So I'm not really keeping up, but I'm keeping up as best as I can. I've been buying short-term 3-4 month treasuries, bought this morning at 4.45%.
Wow, that's crazy.
Yeah, in fact,
Right.
I started that a couple months ago, and I've been laddering them in, and it's been somewhere between 4.1 and 4.4% that I've been able to buy at. And
Yeah.
I'm getting a little concerned because Powell came out this morning and said they're going to start to decrease the rate of increase on the interest rates. And I am concerned that, that 4.4, 4.5% range may be short-lived. We'll have to see. It may come down eventually.
Yeah.
But I'm taking advantage of that for now as I can, mostly waiting. Again, I'm really patient and I'm very careful. So I'd rather wait longer than shorter and not buy at the wrong time. And I know that that's tough to do, but it's also the way real estate works. It's slow.
Right. So can you give an example of what you are buying? Some of the opportunity. What does the profile of that look like right now?
Yeah, sure. This is going to sound all very random, right? But just some stuff I've invested in this year. We're going to put the startups aside. I made a couple of startup investments, very random. But let's see. I've invested in a whole bunch of tax abated apartment buildings this year because they typically add a couple hundred basis points spread. And you heard that right, on the purchase price and the closing price based off the change structure that was negotiated with the local housing authority. And it gave me a couple hundred basis points padding should there be a market adjustment that I was expecting. So that was very comfortable for me. And those buildings are typically income restricted for about half the units. And that tends to work very well in a recession when you've got income restricted units in terms of not having to reduce the rents very much because they're already very low. So invested in a bunch of those. I invested in some ATMs. I've been investing in ATM machines since 2008. And I started in January of 2008, went through the previous recession, kind of saw what they do from a revenue perspective there. I'm pretty confident they'll do fine during a recession given the margins. So been continuing to invest pretty heavily in those this year, despite everything that's going on. Just made another investment in them probably in the last month or so, maybe a month ago. And by the way, one key thing about those is that that's an asset that we know is depreciating to zero anyway, right? You've got like picture an ATM machine. It's a screen, a computer, a bill feeder, a case, and a keyboard. All that stuff's a computer going to zero, right? That's why I continue to make that bet, because I think it's going to perform well during a recession. And I'm not worried about the asset value depreciating, which is what I'm worried about right now in a lot of hard assets. So, and I think, so I'm expecting the cash flow to continue, hopefully during a recession. I'm currently about to invest in a laundromat. Very unique situation, very old owner, needs some value add improvement, heavy cash flow, low multiple, and targets lower end and not upper end laundry. Upper end laundry can take a hit during a recession if people are delivering and maybe they're not going to do it as often. That lower end tends to come in and they don't have an alternative. They don't have, if it's near a lot of apartment buildings that do not have washing machines, you can wash your clothes a little less frequently. But if you look at surveys, one of the top things people focus on during a recession is keeping their clothes clean as a priority of how they spend their money. So that'll hopefully do well during a recession, kind of unique opportunity at unique pricing, which is very important right now. But again, that's a cash flow based investment with very little in the way of assets, right? And those machines are depreciating to zero anyway. And what else have I been doing? I'm just investing in a cannabis industrial facility with a very long-term tenant. I don't do very much of that at all, but I've invested with this only one company I've ever invested with in the space very successfully. And I'm making one more investment at that because I think that will do well in the downturn. People continue to typically buy alcohol and other items like that. So as you can tell, I'm trying. And by the way, that's a very unique situation because rents are much higher than normal industrial building. It's actually cross collateralized. It's a very unique structure. So, so there's always opportunities out there, right? That's what I think people need to understand is you need to be open-minded, and there's any time, no matter where we are in the cycle, there's opportunities, but at some times they have to be more unique than others to make sense of them, right? In a couple of years from now, presumably, you'll be able to invest in almost anything. And from a cyclical timing, it'll probably be easier to find that. It'll make more sense to buy a market rate deal. Right now, it requires a lot of caution.
Yeah, completely agree. I mean, there's so much, basically, if you think about it, fear sells, right? So all the
Yes.
media outlets and everything, they're talking about recession, right? All of these things. And, we have to remember, again, history is the greatest lesson, right? And, with all of this volatility and uncertainty also comes amazing times for opportunities, right? So, if
Yes.
you're positioned well and you're savvy about really understanding, fundamentals, your investor DNA, as you talked about, then there's going to be some massive opportunities, I think, in the next, 12 to 24 months.
Yeah, this is the classic Warren Buffett quote of be fearful when others are greedy and be greedy when others are fearful. And that fear has already started, but it's going to get worse, I think, due to recession and probably not a leg down in the stock market based off of reduced earnings for corporations. And it's interesting to note that if you look at Warren Buffett, he has, I really don't want to use the wrong numbers. It was 130, $150 billion in cash. But he's not really acquiring much at the moment yet. He made a couple of acquisitions recently, but it's been a slow pace. So I think he's also expecting people to become more fearful before he really deploys his cash, which is interesting to watch,
For sure. Where do you think some of those opportunities might lie?
Yeah, well, so, if you're a real estate investor, I think that one of the most obvious places is that they're already starting to and will become more of volume from a volume perspective of people who were buying buildings in the last year to two who had value add business plans that they cannot execute on. Either they just weren't good at executing on them or the market isn't agreeing with them. And now they're starting to have trouble with their loans. They're starting to have trouble because they can't afford the $4 million rate cap that I mentioned. Those are going to be opportunities that are going to come up and continue probably for the next 2 to 3 years. With the exception, if interest rates go way down, that'll become less of a problem for them. But those opportunities are already surfacing. They're already starting to come up. So that's opportunity number one. Putting that aside, I think that the general concept that asset values will adjust and are already starting to adjust breeds a ton of opportunity across everything because nothing's immune, right? If interest rates go up, people pay a lower multiple for something. They have a higher cost of capital on the debt side. So I think there's going to be opportunities across the board, to be honest. I think it's going to be a very interesting time. And even for stocks, I haven't invested in stocks. I sold my stocks all the way back between 02 and 07. But if you look at Amazon, which is I think down 50%, may go down further. Some really bellwether companies, Tesla, I actually am not a believer in the current valuation of Tesla at all, but I know a lot of people are. And if you're bullish Tesla, it's down over 60%, I think, that I've watched it this year alone. I think it's tumbled. Hopefully I don't have my numbers wrong. But so there are currently and will be interesting opportunities, even on the public equity side, for some really solid, huge, well-performing companies. I think those are going to be a very interesting opportunity as well.
Yeah, it's interesting. So part of our investment thesis, Jeremy, is really looking at things really from a three-dimensional perspective, right? So we like to look at assets that are tax efficient, that have predictable passive income coming from them, and do have some type of appreciation component to them. So it's interesting because you can actually flip that to the opposite end, right? And say, hey, this is how we have some risk mitigation, right? Because certain assets that you invest in, you might get bonus depreciation, you might get active depreciation,
Yeah.
Right out of the gate, right? So even if you, achieve a lower multiple upon the exit, right, you've got some savings in the tax side. Then you start receiving some of the passive income. So I like to have basically, investments in things that you're doing multiple things, with your capital, because that's also, not only is it a multiplier, but it also mitigates your risk multiple ways.
Yeah, I couldn't agree more. And, I don't invest for tax savings. I know some investors who specifically focus on that, but I very much go heavier when there are tax savings involved. So the ATMs I mentioned I'm investing in this year, they have 100% bonus depreciation. That is a huge deal, depending on how much you're investing in them, what you expect your income to be, et cetera. There is a lot of different ways to invest that can be very beneficial just beyond the cash flow itself, to your point.
Right. Are you classified as a professional real estate investor?
Well, I have a real estate broker's license since 2008 in California.
Okay.
I got it originally for hard money lending. And then when the SAFE Act came out in 2012, I couldn't use it for that anymore. I didn't bother getting a second license. So it's kind of just sitting, and I do the education every 4 years to renew it and like pass those tests. But so I don't need that because I'm a full-time investor. So when you're a full-time investor, it's kind of unnecessary because I don't really have W-2 income besides my S Corp.
Right.
And that's just because I have to have W-2 income.
Right. Got it.
Yeah.
That makes sense. So, Jeremy, if you could give just one piece of advice to our listeners about how they could accelerate their wealth trajectory, what would it be?
Boy, one piece is tough. Well, the really easy one, it's almost a cop-out, is start as early as possible, right? Everyone always wishes they started earlier if they found a good path. So the sooner you can find that path, or you want to go down the path, the better, just in terms of being able to compound over the years. But I will say this. Let's talk about how I started, in that I think it'll be interesting for people to hear. So, the simple equation when I started in 2002 is you can get 10% cash flow in a typical stabilized property. Okay, that was back then. But I didn't have $1 million to generate $100,000 in cash flow and get out of the corporate world. That just wasn't my situation. So what I did, which I don't hear a lot of people talking about, is I did a two-pronged strategy of investing in some of those, for sure, for more stabilized cash flow, along with some opportunities that I call fully amortized. Okay, ATMs, and I'm sorry, I keep going back to just a really easy example. So on the ATMs, you're investing in an asset. It's depreciating to about 5% residual value, let's just say projected, right? Maybe a 5% resale value at the end. You're losing 95% of the value along the way. So your payments have to be very high to make up for a good total return, because you're only getting a 5% payout at the end on your initial investment. It's not like a property where you will very possibly get more than you initially invested when it sells, right? So, but what that does is it actually accelerates your cash flow. So I call it supercharger cash flow. So I had a combination of amortized and non-amortized opportunities, which really boosted my average cash flow each year. And you're able to compound that. That can boost your long-term wealth, right? Because you asked that question. So I think the danger of doing that is that if you're living off the cash flow and you're not having an underlying asset value that's holding its value, if you live off all of it and there's a 5% payout at the end, you've got nothing left. So it's very dangerous if you're going to try to live off it, but if you're going to try to compound and not necessarily live off of it, you're going to compound much more quickly by having a combination of both as more diversified type portfolio. There's other examples of stuff you can look at that's like that. But imagine if you're the bank, in case you're not understanding what I'm saying, a bank is giving you a 30-year fixed rate loan on your house. What are they getting at the end as a payoff? Literally nothing. They're getting payments, the same payment every month for 30 years, and they've got nothing at the end. So they're getting a combination of interest and principal, and that's giving them a higher level of cash flow than they would have if they gave you an interest-only loan where there's a big payment at the end. So they're actually able to compound that situation as well, right? So similar idea, and I think that could be really effective in helping to build higher amount of wealth longer term.
Yeah, no, really great strategy. And I'd just like to throw in there again, that kind of ties back to your investor DNA and really, your own personal risk tolerance, right? So that requires a lot of discipline to be able to take that cash flow and then put it back to work and recycle it so you can start compounding it. Some folks, right, having that liquidity can be dangerous.
It is dangerous, and I want to just stress that what I did was, once I got out of the corporate world, because that wasn't my intention before, I was trying to build that wealth like you mentioned, I then very specifically rotated out of some of the amortized stuff. I still have some, as you can tell, but I went to a much healthier balance of more non-amortized stuff, like where you're getting a big payment at the end, so that I wasn't going to just eat through all my cash flow living off of it. It was a very important thing piece of strategy that I had to employ over the next few years to reduce my exposure to the fully amortized stuff and increase my exposure to non-amortized stuff, so I wouldn't have that risk for myself. So you got to be very careful with it.
Yeah. No, and I would also like to just draw some attention again to another thing that you pointed out, and I think people just really underestimate it. I mean, it's really Albert Einstein had the quote, right? The what is it? The 10th miracle. I'm gonna bastardize this one, but it's all about compounding interest.
Oh
right?
yeah.
And the power of that. And we've actually built some calculators that we have for people. If you actually withdraw your 401k, pay the taxes and penalties, and then compare that against something like investing in multifamily and where you would be over a 20-year period, or some other real assets. And it's really, really compelling to see that on paper.
Yeah, and I tell you, that could really help you as an investor too, because just knowing the theory behind that and how it works, and if you've never looked at a spreadsheet and what difference it makes, you will be shocked, right? Depending on what interest rate you assume. So knowing that alone, it helps me. Not that I'm a fancy guy, but it helps me to like stay away from the concept of, okay, about to buy my wife a car, right? How much should we spend on the car? Well, every dollar or $100 that's not going towards the car is going to be compounded into an investment which yields an unbelievable amount over 10, 20, 30, 40 years, right? So it actually impacts a lot of decisions I make, not just the investing decisions. So but just knowing what the spreadsheet looks like can be very powerful.
Yeah. Awesome. Great advice. Jeremy, it's really been a pleasure to connect today. I know you've provided a ton of value for listeners that are really going to enjoy this. If folks want to reach out to you and connect or learn more, what's the best place?
Yeah, absolutely. So the best way to reach me is through email. Everyone's welcome to contact me. My email address is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So again, it's jroll at rollinvestments.com. And I just want to thank everyone for hanging into the end here. And hopefully this was helpful for all your listeners.
Yeah, you bet. And we'll make sure to put that into the show notes as well, Jeremy.
Great.
All right. Thanks everyone for joining us today and spending your most precious asset with us, your time. Appreciate it.